So, all right, here we go. All right, so our methodology, it's very simple. What we're trying to do is look for long-term and reliable resources for market information and analysis. We also want to understand the science that they're using behind that analysis. All right, and so the logos on the right-hand side, those are just some of the resources that we have used and pulled from in order to put this together. What we're trying to do is provide you guys with real-world, actual information that doesn't have an agenda. All right. So disclaimers before we go. Nobody can give you perfect advice. All right. Not me, not Andrew, not anybody. If anyone is telling you they can give you perfect advice, run far and fast from them. All right. This is what we're seeing take place. Right. That's what we're presenting to you today. This is what the science has to say. And based on all that above, this is the best advice that we can give you as of today. All right, so here we go. I'm going to start off with Andrew with a mortgage lending update. I know that there's been quite a few questions about what's going on with the mortgage. They're hearing it's hard to get them, credit's tightening. So fill us in, what's going on with mortgages?
Yeah, so I'll give you some updates here, Ryan, and then if there's questions that people have, I can answer those as well. But there's a lot that's been changing in the mortgage world lately. Mortgages are all about risk, and people either call me, or whether it's for a purchase or a refinance, and they want to know what their interest rate is. It's all based on risk. The interest rate is a reflection of the risk relative to what's going on in the market. Of course, things move around, but the more you put down on a purchase, for example, the less risk there is for the bank, and so the interest rate's lower. So everything in mortgages is really about risk. It's about the shortest sentence I could use to sum up the mortgage world. It's all about risk.
Mm-hmm.
And so what's been happening lately has been a change in that risk and the appetite for risk. And it's translating to changes in liquidity. In other words, the money that's available for lending, and also the requirements or guidelines that tell us what requirements you have to meet as a borrower in order for us to be able to lend to you, and things like that. So first thing I'll do, though, let's talk about rates, because everyone's really kind of curious. Most people are hearing that rates are super low right now. A month or two ago, when people heard, you've got to be careful about what you see in the news and what we call like the headline, okay? Because the headline is very misleading from what's actually going on. A month and a half ago or so, the Fed reduced the rates to zero, and so everybody thought, oh, the Fed reduced the rates to zero, so does that mean that I can get a zero rate on my mortgage? So that just kind of, no, that's not what that means. And so just a quick note about that, and the Fed, or the Federal Reserve, their job is to create financial stability in the economy, and they do that by trying to stave off inflation when things are going really gangbusters, and they do that also by trying to stimulate the economy when things are going poorly, and they need to encourage growth in the economy, and they do that through what is referred to as monetary policy, and they have many ways that they do this. One of those ways is that the Fed controls several interest rates. One of them is called the Fed funds rate, another is called the discount rate, and those are rates that the Fed loans money to banks or institutions, and also they control the rate that banks loan to one another. So at the end of every single day, every bank that's a depository bank, they're allowed to lend out a certain amount of their deposits. And then at the end of a certain day, they may be over or under that. And let's say that they've loaned out too much for the day. They're just lending. And all of a sudden, at the end of the day, the books balance out, and they realize, oh, shoot, we've loaned out too much money. We need to have more on deposit relative to how much we've loaned out, okay? So what they do to shore up the books is they can borrow money from the Federal Reserve. So when you hear that the Fed reduces rates, that's really the rate that they're controlling. They're controlling the rate that banks borrow money from the Fed to balance their books and things like that. Now, how does that control and translate to interest rates that you and I see every day in the mortgage world when we're trying to buy a house or refinance? Well, if the Fed raises the rates, the cost of the money that they charge banks to borrow from them, banks will be more apprehensive and less likely to loan out their own money. Because if they loan out their money and all of a sudden they don't have enough in their, they've loaned out too much relative to their deposits, they've got to turn around and borrow that money from the Fed to balance their books for the night. They do this every single night. And if the cost to borrow from the Fed is high, well, then the banks are going to be more conservative and lend out less of their money, okay? On the same token, if the Fed lowers their rates a lot, it creates a situation where banks can borrow money from the Fed really cheap. Like right now, the Fed has lowered that the target Fed funds rate to 0 to 0.25%, basically 0%, which means that big institutions can borrow money from the Fed at 0%. They can turn around and lend it out to you and me at 3.5%, 4%, whatever it may be, and make that as profit. As the rates are lower, people can borrow more money, they can spend more money, and that stimulates the economy. So that's really what the Fed's role is. So just to be clear, the Fed doesn't control the rates that you and I see every day, but they influence them. So when the Fed reduces the rate to 0, doesn't mean you and I get a 0% rate. What it means is that they're making money cheap to borrow for big banks, so that the banks and the institutions may then borrow that money from the Fed cheaply, turn around and lend it out cheaply to you and I, so we can then turn around and use it, spend it, and that's what keeps the economy going. Okay. Mm-hmm. So why would the Fed lower rates like that? Why would they try and influence rates lower? Well, that's because the economy looks like it's maybe not doing so hot. Right now, we have, I don't care where you stand politically, whether you think we should go back to work or stay at home for longer, doesn't really matter. It's not what I'm talking about here. We have shut our economy down. Like, we're done. There are businesses that have closed that will never reopen. There are businesses that have slowed way down and are going to struggle to come back. And there are some that are going to thrive right now. But our economy has taken it in the shorts right now. And the Fed needs to stimulate this economy, so they're pushing rates down. As the economy takes off and we start to experience inflation, the Fed will attempt to lower inflation by raising the rates, so it becomes more expensive to borrow. That takes me to, okay, rates. Okay, all that discussion, first I want to get to this statement, because people are saying, well, what are rates doing? Well, rates are low right now. Mm-hmm. And now this is the part that I think will be valuable for you in making a decision about refinancing or buying a home or having a discussion with your mortgage professional. The question is, what are rates going to do in the future? Well, I don't have a crystal ball, and I don't know that answer exactly. I mean, if I did, I'd be taking this call from a beach in Hawaii somewhere, but look at the economy. The economy is not doing well right now. We were a few months ago. We were doing amazing. The stock market was putting in all-time highs. We had record low unemployment rates. The economy, by all metrics that we use to measure the economy, we're doing was going gangbusters. Now the economy is not doing so well, obviously, and it's going to take some time for that thing to recover. So when people say to me, hey, what are rates going to do in the future? Well, I can't tell you if the rate's going to be 2.5% next week or a month from now. But I do think rates are going to stay low for a while. How low? Don't know. Now, this is what's important. We're doing, right now in the mortgage world, we are swamped doing tons of refinances for people, right? People are taking advantage of the lower interest rates. And this is the word of caution that I would give you. I have this conversation multiple times a day with people. They'll ask me, they'll say, well, Andrew, that 2.75% rate sounds really good. But I mean, do you think they might go a little bit lower? Like, could I get 2.5% maybe? And the reality is I don't know. And this is the important advice I want to give you. This is somebody I'm talking to, for example, that's got a 4% interest rate right now. And I can reduce them down to a 2.75. And, we get, without getting the details of the costs and the APRs and all that type of stuff, they're going from a 4 to a 2.75. And they're going to save $350 a month on their mortgage payment, just for example. And they say to me, well, should I wait? With the rates, might they go down to 2.5%? I said they might. But they also, for a number of reasons, which I'll get into in a minute, they also could spike back up again. And so the advice that I'm giving people right now is it's the classic bird in the hand is worth two in the bush. All right. I don't know what the rates are going to do next week or next month, although I do think they're going to stay relatively low for the foreseeable future, like the next couple of months maybe. Will they go to 2.5? I don't know. What I do know, as I'm saying to this particular type of a client, what I do know is that right now I can refinance you from your 4 to a 2.75 and save $350 a month. That I know. And so, what I watched happen this in the first quarter of the year, the rates began to really drop off, and then we hit some of this liquidity issues that we've experienced, and the rates shot back up again, and a bunch of people lost the opportunity to refinance. Then the rates came back down into range again, and a lot of people are refinancing again. And all those people, when the rates came back down in the range, they're like, sounds good, I'll take it, do it now, right? They lost out and almost lost out the opportunity to refinance. And so that's the advice that I would give you right now. If you're looking to refinance, where rates are now, they're low. Burden of hand, I mean, if you can save money, if the cost relative to the monthly payments, the break even is a reasonable amount of time. So you want to look at a break even analysis. So just for example, if the total costs were, you know, $3,000 and you're going to save $100 a month, you take the total cost divided by the monthly savings, you look at that recoupment period. In that example, it would be 30 months. It's just 2.5 years. How long do you plan on keeping a house for? I'm going to save $100 a month. I'm planning on keeping the house for 5 to 10 years. I'm going to recoup my costs in 2.5 years. That would make sense. But could they go lower? I don't know. So be careful that you're not.
Let me hop in real quick. So we had some new people that have been trickling in as we've been going. So for those of you that have just come in, we were on with Andrew Paul, who's one of the branch managers over at Benchmark Mortgage, one of the top lenders in the county without a doubt. He's basically just giving us a lending update, kind of what's going on. So again, anybody who's new, if you guys have any questions, please feel free to type them into the chat, and we'll get right to them either at the end or as we go. So Andrew, keep going, please. Sorry about that.
Yeah, so basically all that little kind of intro piece on the Federal Reserve and what's been happening to rates lately, the big piece of advice that I can give you is now is a fantastic time to take advantage of lower interest rates. But be careful that in your effort to chase some savings, which you should take advantage of and at least explore, you know, if you get presented with a rate that's really good, you can save a bunch of money and the break-even time makes sense, people have a tendency to lose out trying to chase just an eighth or a quarter better in rate, and then they lose out. Right now, it's a classic bird in the hand is worth two in the bush. Okay, so that's the best advice I can give you. Now, in terms of your specific situation and does it make sense to refinance? Well, again, you got to look at your current rate, projection, you know, the rate being offered, what the costs are, how much you're going to save, the interest saved over time, the break even, and see if that aligns with how long you plan on keeping the house. It is a good time to refinance. The rates are low, but if it makes sense to refinance, depends on your specific situation. But just again, don't chase like an eighth veteran rate. You could lose out, as I've seen a lot of people. The swings in the rates have been pretty volatile. They go up and down, up and down. People are, while they're thinking about it, hoping to get an eighth veteran rate, they lose out altogether. And then they got to hope that it comes back again in another week or two. And sometimes it does. And then they can jump back in. But also on that note, more than just what's going on in the rates, I want you to understand what's going on in the industry right now. In the mortgage industry right now, lenders are inundated. They're absolutely flooded with requests. I can tell you, for me, I am so inundated, I'm having to focus my time and attention on my past clients first. You go to a big box retail bank, forget it. There are some banks that are quoting 6 months turn times to refinance. 6 months is how long it will take for them to refinance your house. That's an actual thing I got from a bank, okay, in writing, 6 months. So the other thing that I see happening right now is loan officers, banks, underwriters, the whole system is overwhelmed right now, just absolutely overwhelmed and inundated. And so if you are able to get in line and speak with a professional who will take care of you and give you a deal that makes sense and they can do your loan in a reasonable amount of time, the danger, and I'm not saying not to shop around because you should make sure that the deal you're getting makes sense, but what's unique that's happening right now is this is the analogy that I see happening. It's like you show up at Costco and you get in line for the meat counter, and the line's out the door, right? So they say, take a number, right? And you finally get up to the front of the line, you finally get an appointment, you finally get the quote, and they say, okay, I can give you this rate, or they say, hey, these steaks are going to be $22 a pound, and you're like, oh, that sounds pretty good, but I'm going to go run down to Vaughn's real quick and see what they've got for me. So you run down to Vaughn's and you find out Vaughn's is charging $24 a pound. And you're like, oh no, Costco is better. Hey, Costco, cool, I want that deal at $22 a pound. And they're like, hey, the line's out the door, man. You got out of line. You got to take a number and get back in line again. I can't even talk to you until next week. I've got appointments stacked 5, 6, 7, 8, sometimes 10 a day, back to back to back. That is how inundated the industry is right now. One last perspective on that to show you how inundated the industry is. When these rates came down, I saw a report, a study about a month ago now, that said as these rates came down about where they are now, so in America, in the country, there's about 11 trillion in mortgage debt. Okay, that's all mortgages combined. That's my mortgage, that's your mortgage, first, second, home equity line. There's about 11 trillion in mortgage debt. Okay, and when the rates came down, this study showed that it was estimated that between 40 and 60% of all mortgage debt was in a range that it would make sense to refinance. Okay, so it's 11 trillion in mortgage debt, and somewhere between 40 to 60% of that is in a range that it would make sense to refinance. So let's just say that that's 6 trillion in mortgage debt. Okay, 6 trillion in mortgage debt is in the range to refinance right now. Okay, any idea how big the mortgage industry is? I'll give you an idea. In the last collapse, okay, the industry shrunk to just under 1 trillion in total mortgages done in a year in 08, 09. And when it went below 1 trillion, everyone was like, oh my God, the mortgage industry is imploding. Last year, the mortgage industry had its biggest year ever and closed about 1.8 trillion in mortgages. That's the most like the industry. That's all banks, credit unions, big banks, brokers, everybody closed about 1.2 trillion, 1.8 trillion in mortgage debt. So if that's the capacity of the industry, I'm talking about everybody. The whole industry has the capacity to do 1.8 trillion in loans in a year. It would take 3 years for the industry to chew through all 6 trillion in mortgages that are in a range that are eligible to refinance. So that's just the last piece I would give you, just to have a little perspective on just how inundated the industry is. So if you've got a professional that you work with, if they have the capacity to do your loan, and they can get you in and get you your rate locked in at these great rates, take advantage of that. That's the big thing, is that people are just they're losing out by either hoping for an eighth bet or somewhere else, or running down the road or something like that. So that's just kind of some interesting things going on. Last little piece I'll tell you about is there has been some tightening in some credit guidelines. You're seeing mortgage companies across the board beginning to raise their minimum credit scores to do loans. It's different from company to company. I did just hear that Chase came out and said that they are going to require a 700 credit score on all loans going forward. You know, that was something that was in the news media. I mean, I can tell you our guidelines aren't like that. And it's different depending on conventional VA, FHA, et cetera. So you are starting to see some tightening in the credit markets. Just lenders don't want to be that bank holding the 590 credit score loan where nobody's willing to take that loan. And so lastly, I would just say too, in my world, I can tell you that jumbo loans are gone. Like we can't even do jumbo loans anymore. By jumbo loans, I mean a loan amount that exceeds the county loan limit. So for San Diego County for 2020, that loan amount is 701,500. So you can't get a loan for more than 701,500. Otherwise, it'd be a jumbo loan. Now, some of the big retail banks in-house will still do a couple of those, but they're going to want 720 or better credit, 20 to 25% down, and 6 months to probably close it. So what we're doing is we're just getting a little creative using first and second. So using a combination of a conventional loan in combination with a home equity line second, so that we don't have a single loan that steps up into that jumbo category. And why is that? There's just no appetite. Investors that ultimately provide the liquidity for loans to happen, nobody wants to be stuck holding that hot potato. The reason why the loans below the jumbo exist still is because of Fannie Mae, Freddie Mac, and Ginnie Mae. Those are the three GSEs, or government-sponsored entities, that provide liquidity to the mortgage industry as a whole. They become the buyer of the notes at the very tail end, and this is what provides that liquidity. If it wasn't for that, I mean, it was, in general, I don't just mean us. I mean, mortgage companies around the world, country wouldn't be able to do loans. So, yeah. So for now, we're seeing a real lack of liquidity in the jumbo market space. Yeah. So those are some of the updates they've got. I could go on and on and on and bore the crap out of you guys. But if you got questions, you can fire them away. But that's a little update on where rates are. Again, just in summary, I think rates are going to stay relatively low for the short term, just because I'm looking at what's going on in the economy. When I start to see that economy turn around, that's your key. The rates are going to go up. There is some tightening in the credit markets due to credit scores and things like that. And jumbo loans are a bit of a unicorn these days.
Yeah. All right. I love it. I love it. A couple things, just I want to put a little finer point on some things. So when Andrew was saying the difference between the rates, he was saying going from the low fours to the high twos, and he gave out a random number of $350 a month that you're saving off your mortgage, right? That's $126,000 over a 30-year mortgage, right? Just to put that into perspective for you. And then the other thing, Andrew, talk real briefly about the person that's waiting for whatever reason it is, and instead of the rates coming down, what happens if they bump up 0.5%? And let's say that this is somebody who you had just pre-qualified for, let's say, a $1 million purchase. What did that do to their purchase power?
Well, there's a bunch of moving parts there, but I mean, it could be, it could be anywhere from 20 to 45 or $50,000 in buying power. So just depends on the taxes and things like that. But I don't. The point you're getting at is a point that I remember talking in depth about several years ago when we were at that time at what was the low before we kind of went back up again. And that was the conversation. And I think the point that I would make about this that maybe you're getting at, Ryan, is when you're out there looking at homes right now, and Ryan, you're on the real estate side, I'm on the mortgage side, okay? But sometimes we look at a house and we go, well, I like that house at $700,000, but man, I only want to pay $680 for it. And you negotiate back and forth, and the seller's willing to come down to $690, and you're like, well, I'm not going over $680, and the deal falls apart for $10,000. Okay. This was a big deal a few years ago. What I was telling people, what I recognized anyway, was that the opportunity right now wasn't so much to buy the home as it was to buy the home and lock in these historically low interest rates. So if you buy the house for $690, which in this example is $10,000 more than maybe you wanted to spend, right? Because you're focused on that dollar price. You're like, no, that $690 is too much. I'm not overpaying. $680 is as high as I'll go. Okay, fine. But rates go back up, and then you look at the interest that you pay over time. Even if you had gotten it at $680, you're going to pay more, as opposed to, hey, pay the $690, get the 2.75, 2.99 rate, whatever it is, and the payment is still lower because of so in other words, the opportunity is in the rate right now, the rate environment. The opportunity to lock in a 30-year fixed mortgage in the high twos, it's just, I can't even believe it. Like you should borrow as much as you can right now for as long as you can. And as inflation goes up, it'll inflate that debt away, and it'll make the payments feel even smaller and lower as things begin to turn back around in years to come. Yeah. So anyway.
All right. Good deal. Good deal. All right. We do have a few questions, but we'll save those for the end. All right, there you go. That is the mortgage lender update portion of This Week in Housing San Diego. So that was with Andrew Paul, branch manager with Benchmark Mortgage. Great information there on what's going on with the mortgage industry. If you guys have more specific questions, all of Andrew's contact info is right there, phone number, email, and all the different social handles right there. Feel free to reach out to him. If you guys wanted to discuss any of this further with me, the tiny URL is the way to book a day and a time, take you directly to my calendar. If you guys want to watch more movies that are similar to this, or if you want to watch the full length This Week in Housing, the YouTube link is right there. Hope you guys have a great day. Take care.